Hi everyone. So this is a presentation that I created last week live, and then I put a little bit of brain power into it just to create more cohesion into the campaign that we're starting. Well, technically we're not starting, we've already started it, but a campaign that involves a specific simple strategy and something that we're going to continue doing for a very, very long time. And you might be asking, when can I start? Or, where do I sign up? You can start any time. Sign up link will be at the end of the presentation. But here in this presentation, I'm going to go through the steps of creating a simple campaign for not only just trading, but the procedure and the process going through it can be applied to pretty much anything you want. So the first thing you got to do is first understand what a campaign is. So this is just a definition from online, and basically in the green box there, I'm talking about a connected series of operations designed to bring about a particular result. So that's basically what the definition of a campaign is. So taking that and understanding what it means, I want to create a campaign that has a purpose, especially when we're trading instruments that have that are derivative in nature. So that means you're working with leveraged instruments. So I want to introduce, we have lots of strategies that we use in this Discord channel, but this specific strategy or this campaign is geared toward new traders, very simple traders, or just traders that want a little bit more of a process, and they can't really, they've never really been introduced to a campaign paradigm and go through the process and then own it. So I guess in this presentation, once I go through it, you'll get a sense of the process, and then you'll get a sense of the procedures, and then there's going to be a couple examples at the end of the presentation so you can understand it all at the end. Okay, so yeah, basically we have lots of strategies, and strategies are generally supposed to be strategies that are non-correlated, meaning that your highest chances of making a successful campaign is based on the strategies being non-correlated in nature. And in this specific campaign, we're going to use a strategy called gap reversal, which is known to every single trader in the market. And we're going to try to take advantage of the morning volatility that happens every morning, whether it's a bear market or bull market. So the first thing I want to do is create a name and also a goal. So the name of the strategy, we'll call it the gap reversal strategy, and the goal is just to master it, right? You don't have to master a lot of things. I mean, you probably heard in maybe at school or at work that if you kind of focus on just one strategy and master it, you're gonna be, you're gonna increase your value in that specific one area. If you decide to do a whole bunch of strategies and become a jack of all trades, well, it's gonna be, you're gonna have to learn them all, right? And maybe you have to mobilize a little bit more capital in order to participate in every single strategy. Right? Imagine going to every single sports event because you just love every single sports. So you can do that and you can love every fan, but it's going to be a bit of a pricey hobby. The campaign goal starting balance is asymmetric in nature. So that's kind of the underlying principle in derivatives. Why we trade derivatives is because we can get into a model where we're taking a small risk and getting a big reward out of it. So 1,500 is just my best guess, but it could be a balance that can be greater than 1,500 500 to 15,000 to 150,000. But keep in mind the risks associated with that, whether you're able to handle the magnitude of that drawdown, depends on your total net liquid. Okay, so 1,500 is actually 20 is the number that is an asymmetric number of the total balance. So I want to say, okay, I'm going to start this campaign, but I don't want to start and go all in with my balance. I want to maybe use a portion of it, right? And this portion that I'm proposing is about 1,500. Now you'll have to figure out the position sizing, which I'll kind of not go into detail, but I'll just state the position sizing percentage in today's presentation. But if you go into the deep end, right, going into 15,000 to 150,000 to 1 million, then I would probably expect you to have 10 times that in your total balance, so such that you can use this strategy we're going to talk about. Okay, for example, so if you have 1,500, then maybe you got $10,000. If you have 15,000, then you're going to have 150,000, and if you're going to use 150,000, then probably you got $1 million, right? And yeah, finally, because we're interested, we're going to run a campaign and we want this campaign to be successful. As a result, there's going to be some sort of result that yields from it, from the success. And the expectation is growing the account from 1,500 and generating a gross profit or a resulting balance of 6,800. Okay, so because you're going to have to kind of create a goal, right? Once you start a game, and there's like 7 levels and you accomplish all 7 levels, what's next? Well, that's the end of the campaign, and you're going to either continue the campaign with adjusted numbers, or, stick with the status quo because that's what you like, and then, keep on moving forward. So the advantage of this gap reversal campaign is, first of all, everyone knows about this gap reversal technique. Okay, it's not it's not unknown. You can look it up anywhere. But one of the main advantages is that it's a timely trade. So it trades within a window. The entry and profits are defined deterministically, which is not with such high precision. You can't get it down to the 3 decimal places, but you can get it close to about 1 decimal place, or even better, you can probably just stick with a round number. Okay, and we will predetermine the buy limit and set it in the morning at around 0.62 or $1, and define the sell limit order immediately at 35% respectively. Okay, so that's the determining fact around this gap reversal, and that's an advantage. So once you put in your order and you make that preliminary assessment about where the contract price is going to look like at the open, then you can put in a buy and sell limit order to get the best price. Now, it doesn't really rely on a bull or bear market. It's the result of the bear and bull market that provides that opportunity. And then, so if something gaps up, gaps down, we'll be able to identify that there's something that's worth trading. And technically, this is not a swing trade. So if you're not a swinger and you just want to just get it over with within an hour or two, that's one of the advantages. And you can also hold runners once you kind of increase once you get more comfortable and master the strategy. Another advantage is that it's organized. So instead of just like maybe looking at news for 2,000 tickers, you're more focused on just the pre-market movements. So that kind of helps you focus on that part of the market rather than the news part, because I think if the news is already out, then it's already gapping up really high, and there's going to be some things that you need to know about those type of gaps when the gap greater than expected move. And also the advantage of the final, like for me, I think one of the biggest advantages about this gap reversal is that it'll mitigate your vicarious trading. Everyone's trying to get rich from other people's experience, right? But why not? And if everyone is doing that, then wouldn't everyone be 100,000-aires or millionaires? Well, no, they won't be, because they're trading vicariously. So if you eliminate the vicarious trading by mastering that strategy, right? Because what if the whole market gaps up or gaps down? Then you're going to be stuck in a situation of picking which one. You don't have to pick anyone. You can't pick all of them. You're going to have to pick one, and it doesn't matter which one you pick. They all have an equal opportunity of winning, as long as you understand the rules and the edge that we're going to discuss. I guess the main disadvantage about this gap reversal campaign is that you're capped at 1 or 2 trades per day. And honestly speaking, based on experience and talking with a lot of other traders, 1 trade per day generating 35 to 100% is enough. And if you keep on doing that every single day, theoretically that's much better than losing 9 times and winning one, losing 9 times on a position size of say $1,000, and then maybe at one of them you have like a 5x, 10x trade, and after going through those 9 stressful drawdowns, right? So 1 trade with a high probability of success with a decent return on your investment is great, but some people might think that's not enough and they want more. Well, that will be considered as a disadvantage. So the general expectations that we want to define here is, this is a compound interest calculator using 35%, using a position size of $300. So $300 is the position size that is going to be used for this campaign. And why is it $300? Well, that's going to be, obviously $300 is 20% of 1,500. But with such a small account, normally we would like to have at least 20 trading opportunities, or 21. But there's a funny relationship with position sizing and balance that most people don't understand. It's like there's like an inverse relationship. So if your account is really, really big, the position size actually gets a lot smaller. But when your account is really, really small, then the position size actually starts to increase. So based on I guess my experience, 15 years experience, and also using position size and using Kelly criterion, 20% seems like not a bad allocation amount for a strategy that has a greater than 60% probability of success. Okay, that's just kind of like the general rule, and 60% probability of success is really hard to find. So when you get a 60%, generally I think Kelly tells you to put in like 40 or 55%, but we need to be kind of a little bit sensitive about the way that Kelly approaches the formula, because we have decay as well as a negative component that depreciates the premiums if the price starts chopping. So 300 is a good number, and then if you get 35% per trade, right, on average, it could be higher, it could be lower. Then your daily profits should start to, should be, your first trade should yield about 125, and then with adjusted allocation amount, it should start increasing every single day, little by little. Okay, so this is kind of what we expect for the first 5 trades if all of them averaged or not average, all of them return exactly 35% compounding over day after day after day. Okay. And that compounding, I know it's like day after day, we're looking for 35%, and then the profits are kind of the next position size is increased a little bit. But the reason why I use this 35% compounding trade after trade after trade is because it's an average. 35% is an average. So sometimes you'll get a winning trade of 50%. Some will be 75. Some will be with 15. But as long as you keep on doing that, it should follow, an increasing. Your profit should increase in this way, in this manner, exponentially. Okay, so the campaign general details is basically like any video game. There's going to be like a number of levels. So here, our levels are going to be defined by the time duration, right? Obviously, we're not going to live forever, but in a campaign, we want to just test it out. Or not only test it out, but we want to give a time allotment. So we'll use 4.5 weeks. Okay, so that's about a little over 20 days, I believe. 20 trading days. The average profit per trade will be averaging around 188 in the first 10 trades. So after you go and trade 10 times, you'll come up with an average, and it should be around plus or minus, I don't know, plus or minus 10 bucks, around 188. Okay, and then the average is supposed to be expected to increase in subsequent campaigns. We'll start off the initial position size, as I mentioned before, 20% of 1,500, which is 300. The max position size of a running balance, as the balance grows, will be capped at 20%, always. Okay? So if you get super aggressive, then you have to know immediately that 20% is your max. So for example, if you start off at 1,500 and all of a sudden you're up like at 10,000, and then you're really, really, really bullish about a trade, so you want to be like, okay, let me use 5,000. That's 50%, right? So you have to know what 20% is, which is 2,000. That is your max, okay? And that will prevent you from a phenomenon called risk of ruin. So absolute min position size will be your starting initial position size, which is $300. And regardless of how the account grows, so again, if your account started from 1,500, maybe after 5 trades you're up at 10,000, your minimum position size, your absolute minimum position size, can always go back down to the initial position size of the beginning of the campaign at 300. That's your min. So if you say, oh, I'm going to go with a nibble, then your brain should automatically think 300 regardless of your account balance. So even if it's $1 million to $10,000, your absolute minimum position size will be $300. Okay? It's like the absolute minimum. So minimum position size can have a wide range of minimum values, right? But an absolute minimum position size would be a nibbler or a starter, whichever metaphor helps you understand what an absolute minimum position size, and that will be referring back to the initial. And that will help as your account keeps on growing, because once it grows, you're thinking about getting into the trade, but you want to kind of test it out. You know the number that you're going to test it out with, which is 300, because that should get you around 2 contracts most of the time. The absolute minimum position as it grows, I guess it should be this one would be not the absolute, but the minimum position size as the account grows would be 10%. Okay, so half of 20. And then adjust the allocation every week for every profitable week. So that will be kind of like depending on how many weeks you're into the campaign. But if you feel like you had a good campaign or a good week, you can make an executive decision of saying, okay, you know what, I'm feeling comfortable. I know what this strategy entails. So I'm going to adjust allocation to increase it from $300 to maybe like $425 or $375, whatever you deem as long as it's within not over 20%, right? The campaign edge details, this is what it looks like. So if for return on investments less than 35 or equal to 35%, then you're going to look for market internals of less than 1.5. So that's kind of like the warning sign. And if it's greater than 1.5, then your return on your investment is going to be a lot greater. And this is going to be the campaign edge that differentiates a lot of the gap reversal strategy traders. This is those two statements right there, the conditions. That's the edge. Okay. So if you don't know about that, about these market internals, you can sign up, and then these internals will be discussed on a daily basis. And also there's an example here. Campaign strategy and description. So again, the strategy is a gap reversal depending on the pre-market or the regular gaps. The edge is using the market internals. We have a deterministic approach to our buy and sell limit orders, right? So we have a procedure behind that. So there's structure. We'll keep a running ledger. That's always good practice for a trader. And we've capped the number of trades. So even if you lose on one trade, you're pretty much done for the day. Or if you made one trade and it wins, you're done for. So there's no like a gray area between that. So it's just one or two trades, and that protects the frequency. So the higher the frequency that you're trading, the worse it is, because you're going to go through each trade incurs a commission. Each trade increases the probability of loss because you're just doing way too many in a volatile environment, and you'll get whipsawed, right? So you cap it. You deterministically cap your frequency of trades between 1 and 2 with respect to your position sizing. And then fail-safe procedures, yeah, again, like this is what I mentioned before. Once you have one loss, then you're pretty much done for that day. And just you would go ahead with your normal day, come back on the next day to see if there's any other gapping opportunities. So the routine here is basically the preparation and what to expect. So the general routine for me is that we'll watch the pre-market prices reset at 4 a.m. Eastern time. So if you're not up at that time, because here I'm on the Pacific Coast, you might just, because it's not really necessary. And if you're up at that time, then you get a little preview of what to look for when you wake up, right? So when you wake up, it could be just, you could be scrambling to look for those gappers. But if you see them already ahead of time, then you can kind of look and see if there's any news. And then in the morning at 6 a.m. Pacific time or 9 a.m. Eastern time, I'm going to send out an alert or a message in the trade alerts and the premium alerts, just to kind of identify some opportunities that I'm watching for. And I usually do this on the radar server. So if you don't know what a radar server is, then it's basically a watch list that I use on TradeStation. And it might be a good idea to join to watch us look at the radar together. Anyways, I'll be posting those in the trade alerts. And then at 10 minutes before the market opens, I'll go through a discussion of the VIX and the position of the VIX and the futures. So that gives us an additional edge of what we're looking at for those gaps, if they're going to reverse or if there's any news that's going to capitulate the market, which means that the gaps are not going to fill. And then literally before the market opens, or even 30 minutes before the market opens, we can kind of get a sense. But I'll post 3 or 1 ticker that I'll be trading and the strike price expectations, right? And that will be posted. And then 15 minutes or 30 minutes into the open, I'll send out the trade alert where we'll be opening up a trade with 2 or more contracts within $300. And that all that information is going to be in the trade alert. So here's an example in the trade alert on May 12th, where I wake up and I look at Tesla, which was gapping down, I think 4.5%. And I specifically just said, okay, this is the trade that I'll be taking for a gap fill up. And then, unfortunately, there's no timestamp. But obviously, if I said, good morning before the market's opening, that's before the opening bell. Then I proceeded to talk about which strike price I was going to get. And then I went on voice to talk about the 760. And I think the 760 calls were trading at like $7 or $8. And then when they opened up on that day, we picked up 2 contracts, and the premiums dropped from like $6 or $7 down to $199, and it actually dropped down a little lower, down to $1. But we held through that because I think the trend was spiking higher. Okay, I can't remember. Yeah, it was spiking higher, like 2.12. And we closed one contract at 280, and then the second contract at 460. So that's a lot greater than 35%. On the 13th, okay, so basically the same thing happened. I again, before the market opens, I talked about the VIX futures, and it was trading lower toward the 21-day moving average, and I think everything was gapping up that day. So pre-market prices are all gapping higher. Okay, so it didn't really matter which trade you took. You're gonna get to see some volatility come in to try to attempt to fill that gap. But I think the trend was less than 1.5. I didn't type it in here, but with the VIX rolling over to retest the 21-day moving average, and gap reversal will be a little bit tricky. But if the trend is greater, then I'll be looking to open up the 730 puts, which were trading at $17 at that time. So when the bell opened, they actually dropped all the way down to like, I can't remember. This was, I think I moved to the 720 puts because when these 730 puts dropped, they dropped down to $3. So I had to go down to another strike, 720, so that it could fit my $300 position size, right? So that's what happened. And so I was watching the 735 puts, and this is still before the market opened, because we saw Tesla gap up 7%. So we didn't know at that time, is it going to gap up 7 or is it going to gap up at 6? So we're just watching the pre-market. And then let me see if I can find the next trade alert. Yeah, here, I got it. So let me just see if I can take a snapshot of this. Yeah. So right after I said I was watching the 735 puts, I opened up 3 put contracts in a gapping market that was super bullish, the 720, and I picked up 3 contracts, and that's because I have a running balance that's already greater than 1,500 from the previous trades. So then it filled at 310, and then I closed them off at 310, which is, I think that's exactly 35%. Let me just check. 2.3 times 1.35. Yeah, so I closed it off exactly 310, and then 2 more contracts. Those are 2 contracts. So when I said filled at 310, it didn't say how many contracts, and then I finally closed the last one off at 3, and that was done. Okay, so that's what we're going to be doing moving forward, and with the trend conditions and all the other market internals that we use, we'll be able to kind of figure out whether it makes sense for us to hold one of those contracts for a swing. And that can be determined using the market internals, the trend.